Trading in a sideways marketer, what we call a sideway, is not simply about waiting for the next trend to emerge. It's a silent battle between uncertainty and the trader's survival instincts. The market during this phase is like a shattered mirror, reflecting distorted signals that turn every decision into a high-stakes gamble. Many traders, from novices to seasoned pros, have been captivated by this sideways maze. They try to find light in the darkness, rushing into fragile trades like flashes of lightning in the night, only to be knocked down by whipsaws that shatter their dreams of account growth. Yet, beyond the danger, the sideways zone is a harsh test of both psychology and skill. Understanding the true nature of the market and mastering your emotions during this phase is absolutely critical. In the next section, we'll dive deeper into the hidden dangers lurking in sideways markets and why this is the trap that causes many traders to get stuck and lose their way. Part 2. Current situation and dangers of trading in sideway markets. When a flat market becomes a hidden trap, the sideway market, a price range oscillating within narrow boundaries without a clear trend, is often mistaken as a resting phase. But in reality, it is fertile ground for invisible traps. This is the stage where a temporary balance between buyers and sellers creates small fluctuations, making traders vulnerable to the whipsaw effect and unnecessary losses. Whipsaw. The trader's nightmare whipsaw occurs when the price breaks through a support or resistance level, triggering traders' stop-loss orders, but then quickly reverses direction, leaving traders burned. For example, consider a stock trading sideways between $50 and $55. A trader buys at $51, expecting the price to rise to $54. However, the price drops to $49.50, triggers the stop-loss, then rebounds back up to $54, causing the trader to lose money without gaining any profit. Repeated stop-loss hits the vicious cycle of frustration in sideway markets. Technical signals become noisy due to constant minor fluctuations. This causes stop-losses to be triggered repeatedly, resulting in a series of small but continuous losses that erode traders' confidence and patience. Inexperienced traders easily fall into this trap, struggling to adapt to the unique trading environment. Common mistake: trying to catch the bottom and top. In sideways markets, many novice traders attempt to catch the bottom and top within the sideway range without a clear strategy or disciplined risk management. They jump into trades whenever the price touches support or resistance levels without confirming a reversal trend, exposing themselves to high risk of losses. Sideway market. The battle between two forces. A flat market is not simply a calm period. It is a psychological battleground between buyers and sellers, causing frequent minor price swings. The stronger side may eventually drive a breakout, but during balance, price fluctuates sharply within a tight range, producing many false signals. Psychological impact on traders. The sideway market disorients traders, causing frustration and impatience. Noisy signals lead to random trade entries, triggering a series of stop-loss orders and rapid capital erosion. Panic and loss of patience often push traders to overtrade in attempts to recover losses, creating a vicious cycle difficult to escape. Part 3. Common misconceptions and mistakes when trading sideways markets. The trap of illusions. Trading in sideways markets is fertile ground for countless illusions and common mistakes that trap many traders, even those with solid skills, into dead ends. 1. You have to trade constantly to find opportunities. Many traders believe that when the market lacks a clear trend, they must keep trading non-stop to avoid missing out. In reality, this is the quickest path to getting whipped around by price swings and blowing up accounts. The more you trade within noisy ranges, the lower your win probability becomes. It's like trying to pick up every pebble in a rushing river, not only exhausting, but ultimately unproductive. 2. Technical indicators are always right. RSI, MACD, Bollinger Bands, and others are powerful tools when markets trend. However, in sideways conditions, these indicators often get confused, generating false signals. Blindly trusting them during such times is like heeding the prophecy of a snake oil salesman. It sounds enticing, but the outcome is usually painful. 3. No trend means no opportunity. Many traders mistakenly think sideways markets are just dead zones, not worth trading. The truth is, if approached correctly, these periods can be small gold mines thanks to price oscillations within well-defined ranges. What matters is having the right strategy and a strong mindset to patiently wait for quality setups. 4. Stop losses should be tight to minimize losses. Placing stop losses too tight within the small volatility of sideways markets often results in frequent stop outs. This is like putting a fence too low to prevent big losses, but allowing even the smallest rabbits to jump over easily. A better approach is to set stop losses logically according to the range's volatility and structure, avoiding being stop hunted prematurely. 5. Sideways markets are just waiting periods for the next trend. This notion is theoretically correct but often leads traders to impatience, reckless trading, or missing real opportunities within the range. In reality, sideways markets have their own life, a balance of opposing forces creating meaningful small oscillations that are exploitable if you know how. Part 4. Effective trading strategies in sideway markets. How to survive and profit when the market is moving sideways. Trading in a sideway market isn't about reckless spray and pray or random entries. It's an art of patience, skillful identification, and refined tactics. Below are ways to turn the nightmare of sideway markets into real opportunities. 1. Range trading, mastering the small playground instead of trying to predict a large, unclear trend. Leverage the narrow trading range of a sideway market. You need to accurately identify support and resistance zones, price levels where price typically bounces up or down. Enter long near the support zone. Enter short or exit positions near the resistance zone. Set your stop loss slightly wider than the range to avoid being hit by whipsaws. For example, if a stock oscillates between $50 and $55, you can buy near $50 and sell around $54, $55. This requires patience, as not every signal will be ideal, but it's a much safer and more effective approach than blindly trying to catch the bottom or top. 2. Wait for true breakout confirmation. Don't chase false moves. A genuine breakout from a sideways zone usually initiates a new trend, but identifying a real breakout isn't simple. Prices often fake breakouts, triggering stop losses for those who enter too early. Tactics include: wait for a candle close above or below the breakout zone, accompanied by high volume monitors supporting indicators like volume spikes, RSI, breaking out of overbought oversold zones. Sometimes wait for a pullback to the breakout area to confirm that the zone has flipped into new support or resistance. Not every breakout is a golden opportunity, but when the breakout is confirmed, it marks a clear market trend and reduces whipsaw risk. 3. Selective use of indicators, combined with price action indicators like RSI, MACD, and Bollinger Bands can provide signals, but in markets they often produce noise. The key is combining them with price action to filter out false signals. Confirm indicator signals with candlestick reversal patterns. Avoid entries when indicators conflict or lack consensus. Reduce trading frequency. Prioritize quality setups over quantity. 4. Risk and psychology management. Stick to your rules. Sideway markets can test trader patience, tempting them to overtrade. Set limits. Maintain a favorable risk-reward ratio, at least 1 to 2. Limit the number of trades per day to avoid mental overload. If noise signals overwhelm, don't hesitate to take a break and observe the market objectively. 5. Patience and discipline. Don't rush to win back losses. Ultimately, sideway trading demands more patience than any other market condition. Resist the urge to win back losses or enter reckless trades. Learn to stay out when the market is chaotic. Focus on quality setups and maintain emotional control. Part 5. Psychology and survival skills in sideway trading. The battle of patience and emotional control. Trading in a sideway market isn't just a technical challenge, it's the toughest psychological test for any trader. Here, there's no clear trend to lean on, only small fluctuations, noise, and emotional traps lurking at every turn. The frustration of being on the sidelines. A sideways market is like being in a noisy room where you have to listen carefully to pick out the important sounds. You can't blindly jump into trades as you might during a clear trend, because every signal could be a bait for a whipsaw. New traders often feel frustrated and antsy to do something, leading to overtrading and poor selection. This is the first step into a cycle of losses and psychological burnout. Impatience and FOMO, the silent enemies. Uncertainty in sideway markets often triggers the fear of missing out. FOMO. Traders are afraid of being left behind, prompting rushed decisions and impulsive entries. When prices oscillate mildly, they're easily fooled by false signals and repeatedly hit their stop losses. It's like trying to catch every small wave in a stormy ocean. You're likely to lose balance and drown. Emotional control. The key to survival. Staying calm and patient during a sideway phase is a skill not everyone masters. You need to learn to accept that golden opportunities won't come all the time. Sitting on the sidelines when there's no clear setup is itself a win. Of it as running a marathon, not a 100-meter sprint. You must conserve energy and maintain a steady mindset to go the distance. Good habits to navigate sideways markets. Keep a detailed trading journal. Record every decision, emotion, and outcome to identify mistakes and adjust behavior. Set limits on the number of trades and trading hours per day. This helps prevent stress and fatigue. Practice regular breaks and relaxation. Keep your mind clear and reduce psychological pressure. Continuously learn and improve your knowledge. Understand the market's nature better and adapt accordingly.